Namaskaram, my dear ones. This is Nishanth Reghunath here, welcoming you to a new video from our Financial Management Bootcamp. In this particular lecture, we are starting off with a new chapter, and the name of the chapter is Cost of Capital. See, before I head on to the details or we start learning about this chapter, let me give you a quick briefing as to why do we need to learn this particular chapter? What is the essence of this chapter? All right. See, the name as it suggests, cost of capital, it refers to a cost that is associated with the capital that you raise for a business. Now, what is the cost of a capital? What kind of cost does a business incur for the capital that they raise? See, I'll give you a very simple explanation. See, whenever a person, say an investor, brings in capital to a business, the investor has a particular expectation from the business, correct? So he's like, I'll bring in money for you guys, no problem, I'll bring in money, but then I have an expectation from you. Now, what is that expectation? The business should properly use this money, as in invest the money properly, and via this investment, they need to conduct the operations of the business properly, and from the operations that they conduct, they should make profit. And the expectation, here comes the expectation, out of the profit that the business generates, a share should be given back to the investor. Correct? A share should be given back to the investor. Now, I'll give you a much more simple explanation to this whole concept. Much more simple explanation. Say you want to buy a car. Say this car costs 15 lakh rupees. Alright. You have your own fund of say 10 lakhs. Now the balance, that is 5 lakhs, you are taking a loan. So a bank agrees to give you a loan. Bank agrees to give you this loan, say at an interest rate of 10% per annum. Alright. So you might have come across such a scenario in your life, or you might have come across people who have purchased car and have taken loans from banks and all, right? So when the bank is giving you this 5 lakhs, what are they doing? They are adding onto your capital to buy this car, to buy this investment, to make this investment, correct? Now, what is the expectation of the bank? The bank, they have an expectation for sure. What is the expectation that they have? The expectation is, for this 5 lakh, you will give them 10% per annum as interest. Yes, correct. So the expectation that the bank has is a cost you have to bear. Correct? It's a cost that you have to bear. Yes, simple, right? So this particular cost you will have to bear no matter what happens, because the bank agreed to give you a loan only because they expect in return this particular interest from your end. Correct? In case you fail to meet this expectation, in case you fail to make this interest payment, what happens? The bank will move to legal measures. They might come and say, normally what happens is they'll issue a notice stating that you haven't paid interest. We are giving you a warning, pay the interest. They might give you one more warning, and if you do not abide by that warning, what would they do? They would come and take measures to repossess the car. Correct? The car will be taken by the bank. Yes? So this is the most basic and easiest explanation that I can give for the concept of cost of capital. See, whenever a person invests, whenever an investor comes, as I said, they will have an expectation. Now, this expectation will depend upon the kind of investment. Because an investment can be by way of shares, that is equity shareholding. It can be by way of preference shares. Yes? It can be by way of secured loans, unsecured loans. Correct? So these are multiple ways a company can raise capital. See, please do note, these are not the only ways. I've just listed few examples. Now, whenever the company raises this capital comes with an expectation, right? Now, what is this expectation? Expectation is the company paying something back to the investor, correct? So the capital comes with an expectation wherein the company pays back to the investor, correct? Now, what do they pay back? When they pay back, see, it can, for shares, it can be dividend. For preference share, it can be preference dividend. For secured loan, it can be interest. For unsecured loan, it can again be interest, correct? So whatever that they are paying back to the investor is an expense, correct? An expense associated with this capital, correct? So this expense, I can also term it as cost. So this particular cost that is associated with capital is called cost of capital. All right. So this whole study of yours, this whole study of cost of capital is for us to understand what would be the cost, for a company to raise a particular capital. All right. So this is what we are going to learn in this video. Not just in this video, in the set of videos that you find under this module. So this whole study of cost of capital can be explained to you, as in the relevance or the importance of cost of capital can be explained to you with the help of the following example that I'm going to make. Say the company is raising capital. Let me just zoom this a bit. Yeah. The company is raising capital by the following sources. They're raising equity. Say they're raising unsecured loans. And they are raising secured loans as well. See, when I mentioned previously in the note that I was sharing, each investor, I said they will have their own expectation based on the kind of the investment that they are making. Now, how does the expectation differ? How do they change? How does the expectation change? How does the expectation change from each investment to investment? So how does it change from shares to preference to secured to unsecured? I'll give you a simple example. See, on what basis will you have an expectation when you are investing money? What is going to be the ground rule or rule of thumb? See, you have two projects, project A and B. What is going to be the basic rule that you are going to follow when you are investing money and you are deciding? See, if I am investing in A, I want say 10%. But if I am investing in B, I want 15%. What might be the reason? Simple, the risk. See, the more the risk, the more return or the more expectation you will have, right? So whenever the risk is high, you would expect your returns to be high as well. Correct. So higher the risk, higher the expectation. Lesser the risk, lesser the expectation. So in the four ones that I mentioned, I can easily say secured loans, the risk is the least. Because secured loans, the loan has been secured by a collateral security. So there is very less risk. Therefore, when the risk is very low, your expectations will be very low as well. But out of the four, I can say equity shares will have the highest risk because they are the ones who are going to get paid last, as in the share of profit last. You will first pay secured loans, then you will pay unsecured loans, then you will pay preference share. If there is anything left, you will give to equity shareholders, correct? So equity shareholders have a risk that they will only make money if the company has enough fund with them. Only if the company has balanced fund after paying off everyone. So the risk is very high. So it can be easily concluded that equity shares will have the highest expectations as well. Correct? Coming back to our Excel example. So I've listed a couple of sources, and if I'm to say the risk and the return that they are expecting, say I can put it like this. Second, just make this table a bit clean. The risk for equity shareholders is going to be very high. For unsecured loans, it is going to be high, but not as high as equity shares. So let me give two arrows for equity shares. And for secured loans, the risk is pretty low. Because as I said, secured loans are mostly secured with collateral. Not mostly, they are always secured by collateral. So let me give some numbers here. Say equity share owners are expecting, say, a 25% return. Unsecured loans, say they are expecting a 15% return. And secured loans, they are expecting a 10% return. Okay, so 25, 15 and 10% return is what they are expecting. Also, let me just add one more column. The capital that they've brought in. The capital that they've brought in is, say, equity is 100 lakhs. Let it be 100 lakhs. Let unsecured loans be 100 lakhs and secured loans be 100 lakhs. Alright, so capital in lakhs. So this is in lakhs. Okay. So, as a company, what should be the return that they should pay back to the investors? So the cost that comes to the company would be, for 100 lakhs, 25% is 25 lakhs, correct? So just like that, they would have to pay a total of 25 plus 15 plus 10, that is 50 lakhs in total, correct? Then it would be 50 lakhs in total. Now what is that total capital? 300, 100 plus 100 plus 100, 300. Now, would it be fair to say the cost of capital of this particular company as a percentage is 50 divided by 300 expressed as a percentage? It will be, where is percentage? 16.67%. Yes. So the total cost of capital for the company is 16.67%. It's fair to say, right? See, the reason why we need to know this particular cost of capital is because it's on the basis of this particular cost of capital the company can properly set a target return. See, the company is taking this 300 lakh capital. Company has 300 lakh capital, yeah? Now company is taking the 300 lakh capital and giving it to two departments. Okay, I'll just draw. It'd be better if I draw, I think. And they're giving it to two departments. Department A, B, let it be three departments. Okay, let it be two departments. For department A, they are giving 200 and for department B, they are giving 100 lakhs. Alright. Now, the company knows that their cost of capital, their target cost of capital is 16.67%. So, it goes without saying that department A and B will have to collectively make something more, equal or more to 16.67% so that the company can meet the expectation of the investors. So now the company is telling to department A, I'm giving you 200 lakhs as capital and you can invest it in your project, but make sure you bring us a return of 20%. They're telling B also the same thing. Bring us a return of 20%. Now the whole department A will be working on this 200 lakh invested to get this 20% so that their target will be 40 lakhs. They will make 40 lakhs. Here likewise, they will target to make 20 lakhs. So together, how much will the company make? 60 lakhs. Now this 60 lakhs would suffice to pay this whole 50 lakhs, correct? And they still have balance remaining. So imagine the company did not check their cost of capital. They do not know this. And they go to A and they tell A, instead of 20, A, you bring us 15% capital because your project, we are giving you 200 lakhs and it's a project with high possibility and we are expecting you to give us say 15% capital. So that's a total of 30 lakhs that you're giving us. And department B, your project, the possibilities are a bit less, but then say we can do with 14% capital. We are happy. So B takes 100 lakhs and they bring 14 lakhs return. The company is very happy because they are making good returns at 20%, 15%, 14% return all they are making. The company will be like, yeah, this is good. We can work like this. But what happens is, see, total how much do we have here? Just 44 lakhs that we have here, right? It's just 44 lakhs we have. The company per se might be happy with a profit of 44 lakhs. Alright. But during the closing of accounts or finalization or the end period of the financial year or during AGM or whatever the time is for them to pay back their investors, what will happen is they'll take this 44 lakhs. So they have a total of 44 lakhs, right? They have a total of 44 lakhs. They'll have to pay these three investors. They'll first pay secured loans. They'll first pay 10. Now balance, what do they have? They have 34 left. Now out of the 34, they'll pay 15 here. No doubt, they'll pay 15 here. No doubt. Yes. So now they have paid 25 out of 44. If you reduce 25, all that you have is 19. Now they'll pay 19 to the equity shareholders. Do you see the problem here? See, equity shareholders expected 25, but now they are only getting 19. So it's fair to say the equity shareholders will be disappointed. Now, when the shareholders of a company are disappointed, it will drastically or directly affect the way the shares are valued of the company. Yes, how the market sees the company's shares. Yes. So in the long run, this is going to be a very, very risky deal. Yeah. Very, very bad move from the company for not assessing their cost of capital properly. Yes. But then if they had set this 20%, equity would have gotten 25, secured loans would have gotten 10, unsecured would have gotten 15, and let me just erase this. They had a total of how much? 60 lakhs. They had a total of 60 lakhs. They can easily pay 25 to the equity and still have a 10 balance, and the equity shareholders will be very happy. They might tell the company, you keep it with you, keep it as a retained earnings, or give us some extra dividend. So give us 30 this time. So equity shareholders are really happy, and the word will spread in the market that this company is paying the equity shareholders much more than what they expected, and yet they still have retained earnings as well. So in the long run, that's going to be a great boost for the company, right? Easy way to finance the company. Yes. Now this is the importance for cost of capital. So let's quickly go back to our note. So when you have cost of capital, what you know is, or what you have as a backbone or a support is, you know what to generate. What to generate to pay off the investors' expectations. Now, when you know what to generate, you can easily set proper targets. So this allows proper target setting. Yes. Now with this particular proper target setting, what happens? The investors' expectations can be met. Investor expectation can be met. Right. So good understanding of cost of capital enables us to understand what is to be generated for meeting investors' expectation. So in the previous example, it was 16.67% in total. Now with that 16.67%, the company could set their target properly. They set it at 20%. Now with this 20%, they made sufficient profit such that the investors' expectations were met. Now if they didn't know 16.67%, in that case, we had set a target of 15%. And in that case, the investors' expectations weren't met. So whenever you have a cost of capital, make sure the return that you target is higher than this cost of capital. If that's the case, you can proceed. You can say yes to the project. But you know the cost of capital, but the return on investment that you make is not sufficient to meet the cost of capital, then you say no to the project. So greater than or equal to 1. Okay. So if you can meet the exact cost of capital or anything more than that, it's fine. But ideally, I would say make something more than the cost of capital. Okay. So understood the complete ideology of this particular chapter, this concept of cost of capital, yeah. I'm hoping that you got a really good understanding. In case you haven't, please do let me know. I'm more than happy to take extra effort and explain whatever that you require so that you get concrete idea, your clarity. You have crystal clear clarity with financial management concepts. Now with this, I think it's safe to close this video. It's almost 20 minutes. I think it's safe to close this video. In the next video, we'll go further and analyze how to find out this cost of capital. So we found out it's 16.6 here, right? So our next target is going to be calculation of cost of capital. Now this cost of capital calculation can be made for each security and can be made for the whole company, overall company as well. See, in this example, I gave they are expecting 25, 15, 10. Now, how did I come to these numbers? That's what we are going to learn first. Okay, that we learn for each security, and once we learn for each security, we'll move on to the overall company's cost of capital. So please do note, the whole study will be based on formulas, like formulas for finding the cost of capital of each security. Say there will be a formula for cost of equity, for cost of debt, for cost of preference share, and just like that, a formula for finding the cost of the complete company. That's the overall cost of capital, which is also known as weighted average cost of capital. And also we'll be learning about marginal cost of capital as well, which is pretty similar to the weighted average cost of capital. Okay. So we'll be learning all these formulas in the coming video, and I think with one or let's say maximum 2 videos, we'll be closing the conceptual study of the whole chapter, after which we'll go to the illustrations and everything. So with that said, I'm winding up this video. I hope you had a really good study with this particular lecture. If you did like our lecture, please do show us some love. Give us some good positive feedback, share comments, like, subscribe to our channel, spread the word about our particular community, the KYDU community, because this is the best support that you can give us. So yes, that's all. This is Nishanth Reghunath signing off from yet another video of KYDU. I'll see you in the next one. Tata, take care and goodbye.